Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On today's show, I'm taking you to San Francisco. Yeah, we're going to go to San Francisco today because San Francisco is a fun place to be. If you've never been to San Francisco, there's a lot of cool stuff that goes on in San Francisco, and it really doesn't matter what you're looking for in the form of recreation. Trust me. Everything that you could possibly want to do, barring, like winter sports, you can find it in San Francisco. Now, I've been to San Francisco many, many times, and I will tell you this. It's a very, very expensive city, not only to live in, but to visit. I mean, hotel rooms are very, very expensive there. When you eat out, it's not going to be cheap. Everything you do is going to cost you probably more money than it would cost you back home. But you get the opportunity to experience San Francisco. And I'll tell you, if you haven't done it, you should go do it. You really should go do it. I mean, they got the Golden Gate Bridge. They've got the Presidios there. You ought to go check out the Presidio because that place is really, really cool. And since the entire Presidio has been demilitarized, anybody can go there and check it out. As a matter of fact, what they did with the officers' quarters is they converted them. They basically privatized them, and now people live in those things. Here's another thing about San Francisco that I really love, the seafood. I mean, you get some of the best seafood ever anywhere. Yeah, I'm serious about that because you got that whole Pacific Ocean right there. You've got, San Francisco's a major port. I mean, so you've got stuff coming in from everywhere into San Francisco. And I'll tell you what, if you haven't ridden the trolley cars, oh man, you got to do it. You got to get on that trolley car. You just got to experience it. You got to check it out. And when you're there, maybe you become enamored with San Francisco. Maybe you get this bright idea that you're going to invest in San Francisco. After all, the prices in San Francisco continue to go up and up and up and up. And even when they come down, they bounce right back and they continue to go up again. Yeah. So, San Francisco is that magic place for real estate, right? Because it's one of the most expensive places in the world. But let's just say you find this property, and it's a neat property. It's actually a pretty decent-sized property. This thing is 4 bedrooms, 2 baths, 2,200 square feet. It's a 2-story property. It's on its own lot. It's actually a standalone home. Now, when you go to San Francisco, you're going to see that a lot of those homes there are actually, they're called row homes. In other words, their adjoining walls are built right next to each other. You can't even slip paper literally between the properties. Yeah, but this particular property, it doesn't have neighbors on either side. As a matter of fact, you got a little bit of walking space between you and your neighbor. So that's kind of unique for San Francisco. And it's located literally in the middle of the city. This thing is in the middle of the city. And if you know how San Francisco is like this giant hill. I mean, there's no other way to describe San Francisco. And this thing is like close to the top of that hill. And it's got a great view of the San Francisco Bay. Well, at least from the upstairs units. Yeah. So you're thinking, wow, this could make a good rental. This could absolutely make a good rental. As a matter of fact, as you look at this property, you start to realize that the person selling it, man, they actually did a little work on this thing. They got it ready for sale. I mean, this thing has fresh hardwood floors throughout, new windows. They've repainted the place, and that's kind of a good thing. Now, of course, you don't know if they did anything to the interior of the property, to the functional systems, because there's no information here that discloses that, but that's okay. When you go out and buy this property, you're going to make sure that you do those inspections, because this property, well, it's a little older. What do I mean by a little older? Well, this property was actually built in 1957. So it's got about 60 years on its bones. So you have to realize that back in 1957, some of the building standards were a little bit different than they are today. I mean, we've improved a lot of building standards. And as a result of that, you may have functional systems within this property that are archaic, and they may need some work. So make sure you check that out. Make sure you scope all the lines. Make sure you check to see what kind of plumbing you have. Make sure the property is level. Now, San Francisco doesn't usually worry about foundation stuff, because literally San Francisco is kind of like this giant rock. Yeah, you kind of build your house on a rock. But here's the other thing about San Francisco. They have earthquakes, and that rock, it will move on you. So, San Francisco has experienced some earthquakes since 1957. So you may want to just take a peek at the foundation, make sure everything is fine. Of course, you're going to check the roof. You're going to walk through the entire property. You're going to measure the rooms. You're going to do all the things you're going to do, because this particular property can be bought for $1.51 million. That is what its asking price is. Now, I will tell you that in today's white-hot real estate market in San Francisco is no different. San Francisco is on fire like everything else, because San Francisco has a lack of inventory like everybody else. You want to buy this property, it's on sale for $1.51 million, but the broker is telling you, dude, if you really want it, you're probably going to have to pay like $1.67 million for this beautiful property, and then you're going to convert it into rental property. You're going to make it available to somebody in the greater San Francisco market that's looking for this exact kind of property, that has money to apply. I mean, this property thing, it's a property. It rents for $5,800 per month in and month out. It's got to be a great deal, right? When we come back for the break, I'm going to break down those numbers. You're going to be shocked.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. So we're going to San Francisco. That's right. You and I, we're buckled up, we're in the car, and we're driving light speed with no cops on the road. We're going to get there right about now. Okay, we're in San Francisco. How's it feel? It's a little chilly, huh? Yeah, it gets a little cool here in San Francisco. But here's the thing. We found a property that we think will make a good rental property. I mean, after all, we're in the land of location, right? I mean, we've all heard how real estate prices in California, they just continue to grow and grow and grow. And they do. They do. But here's the thing that you may not have heard about California real estate. There is a disconnect between the values of property and the rental income that those properties can produce. Yeah, there's a huge gap in between those two variables. See, one of the things that we'll teach you at Lifestyles Unlimited is that when those two variables get farther and farther and farther and farther apart, successful investing starts becoming diminished. Yeah, you start transitioning from successful to unsuccessful. So let me do this. I'm going to get into the numbers because I promised you I would. And I'm going to give you some more background on this property because I want you to get kind of like a one over the world approach, because I want you to think through this particular property. Now, again, this thing is, well, ironically, in one place it's listed as 2,200 square feet. In another place it's listed as 1,400 square feet. So what's the difference of the 600 square feet? I don't know. I mean, that's something we would have to figure out. But to be honest with you, that is not important right now. What is important is the analysis of this deal, because we can get enamored with this property. We can go, oh, isn't that such a beautiful soft blue color that's on that property? And doesn't it blend in well with its surroundings? And look, it's so quaint. It even has a little one-car garage on it. Yeah. And you fall in love with this thing. And then you get on the second story and you realize that when you're on that second story, you can actually see out across the San Francisco Bay. It's magical. It's beautiful. It's gorgeous. And on the inside, oh my gosh, they have really made this property beautiful. I mean, there's hardwood floors throughout. There's nice cabinets these are cabinets that were clearly not put in the 1957 era, because these are more modern, and the counter surfaces are more modern. But it still looks a little bit dated, but I'll tell you what. It is functional. It is absolutely functional. It even comes with a washer and dryer, and these washers and dryers, they're kind of high-end stuff. It's not your basic washer and dryer. Yeah, they even put a refrigerator in this particular property. Yeah. I mean, these guys are going all out. And here's the thing. That property went on the market for $1.51 million. Very quickly after that, the property price was increased by the broker to $1.58 million. Probably they had a whole bunch of demand, so rather than just, have 900 offers come in on this property and try and sort through them, they just said, you know what, let's raise the price a little bit more, and that'll knock some people out so that we don't have as many people like wasting their time, because only one person can buy this property. Here's what I think. Given the state of the market, given that just about anything that goes on the market, even trashed out properties. By the way, this is not a trashed out property. This is a good to go property. It really is. And most investors, they think that the way to buy these properties is you find something that's all fixed up, you pay retail price for it, you put 20% down, and then you operate the property and you make your money on the back end. That's what they think. And I'm going to walk you through the numbers right now so that you can understand that those numbers are not in your favor. They're not in your favor. So I'm going to go all out, and I'm going to say this property, because it's actually a pretty cool property, this property will sell for $1.67 million. That's right. It's going to sell for even more than the adjusted price that the broker is asking, because there's nothing else on the market like it. And people will get crazy and they will buy this property, either to live in or to rent out. Now, we're going to look at it from a rental standpoint. We want it as an investment. We're not going to live there. We don't need to live in a property that costs us $1.67 million. And if we do, San Francisco is a beautiful place, but there's a lot of other places in this country where $1.67 million will go a whole lot farther for you. But getting back to the numbers. So you're the lucky bidder. You bought this property for $1.67 million, and you're going to put 20% down to buy this property. Now, you're going to have closing costs associated with this transaction, and you're probably going to pay some loan origination fees, some loan discount fees. I'm going to go big, and I'm going to say your loan fees are like 6%. Now, definitely, that's on the high end. I just want to paint a picture for you. That's really what I want to do, because I'm not trying to sell you this property. I'm actually trying to talk you out of this property. So let's get into that. So you bought it for $1.67 million. You put 20% down, and you've got about $100,000 in closing costs associated with doing this transaction. So your cash out of pocket, are you ready? Are you sitting down? Your cash out of pocket to do this deal is $434,200. That's right. That's what you are going to wire transfer into the escrow account in order to close this deal. And when you factor in all of the expenses and the closing and holding costs associated with doing this transaction, as well as the down payment, you're getting into the deal for about 27.5% of equivalency on the down payment, because you have all these additional fees to get your loan where you're trying to get it. So you've just plopped $434,200 down on this property. You've got a loan, and that loan is in place. It's an 80% loan. You found a lender that was willing to loan you $1.336 million. That's a jumbo loan, but you got jumboed, and you're good. So now you're going to find a great resident to live in this property. And you found one, and they're willing to pay fair market rent, which is $5,800 for this property. You put the resident in, you set their security deposit aside in a safe place, you start operating the property, and then you start to realize that when your mortgage coupon book shows up, you're required to pay $9,065 every month. Now, that's broken down based on principal, interest, taxes, insurance, a homeowners association fee of $25 a month, and I didn't even include any maintenance. So you're paying out over $9,000 a month, but you're only bringing in $5,800. Uh-oh, you're upside down. When we come back, I'll tell you what that means.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. All right, so we went to break, and I was telling you a little bit about this negative cash flow thing. Yeah, this is something that people that invest in real estate, where the price of the property is out of proportion to the rental income that it produces. When you get out of proportion like that, you step into something called negative cash flow or negative carrying costs. So what I've been describing to you is a property in San Francisco, and it really doesn't matter what property it is. I mean, I just literally went on the internet and I just looked at a couple properties and I picked one. I thought, okay, this is a nice property. Let's see if it could work from a rental perspective. And what we're doing now is we're going through the numbers. And what we determined was this particular property, because of where it's located in San Francisco, is probably going to sell for $1.67 million. And you want to buy it. You want to buy it. So you're going to put $434,200 down on that property. That's actually all of your costs associated with buying this property, because you're going to put 20% down. You're going to pay about $100,000 in closing costs, and you're going to get a good loan on this property. I'm factoring 3.75%. You might be able to get an even better interest rate than that. I'm just kind of going with what kind of the market's showing me today. But here's the problem. Fair market rents for this property, $5,800 a month. Now, you might be thinking, man, that's huge rent. That's way more than I pay for my house payment. And yeah, that's kind of the way things are in San Francisco. Now, ironically, if you live in San Francisco, it's actually cheaper for you to rent than it is for you to buy. And there are people that kind of do that balancing act. They go, well, if I'm going to spend the money every month anyhow, why don't I just buy? Because then at least I get the benefit of appreciation. But the trade-off is this. Because those prices are much higher, you're going to have a much higher payment. So let me explain it to you. The property we're talking about can rent for $5,800, but when you buy it, whether you choose to live in it or not, actually, if you choose to live in it, you can get a better interest rate than the 3.75%. But just roll with me here for a minute. Your monthly payment, principal, interest, taxes, insurance, plus the homeowners association fee of $25 a month, works out to $9,065. So if you bought that property to live in it, you would be paying about $9,000 a month. You'd probably be paying a little bit less than that, but that just kind of gives you the balance. And there are people that live in San Francisco that go rent versus buy, rent versus buy, rent versus buy, and they get all confused. And as soon as they realize that they don't have like $432,200 to put down on a property, they're like, I'm glad I can come up with the security deposit and first month's rent. Because, right there, even if you rented this property, right? $5,800 for first month's rent, and let's say you only charge $5,000 for the security deposit. Somebody still has to float over $10,000 just to move into this property. And you found somebody that has no criminal background, has a great credit score. They gave you phone numbers for the last two places they rented. When you called both of those people, they said, man, that person was spot on. I was sorry to see them go. So you're like, this is a good resident. This is a resident that will pay on time, that will take care of the property and not cause me any grief. So you rent that property out to them. Now, they pay you that $5,800 rental check. You've got it. But you've got that mortgage coupon now. And now you're writing a check to the mortgage company for over $9,000, of which $5,800 came from your resident. The other $3,265, that came from you. That came out of your checking account. Yeah, see, if you're going to invest in places like San Francisco, you got to know what you're doing. You have to understand the marketplace. And you're thinking, well, property values, they just go up and up and up, right? Because it's San Francisco. Okay, maybe they do, maybe they don't. Well, the reality of it is they do, right? So every month you are digging into your personal funds to pay out an additional almost $3,300 every month so that somebody else can live in your property. But you're thinking, the prices are going up, the prices are going up. And when you did a search of the historical prices for this particular property, you realized that in 2002, this particular property was the last time it sold. And it sold for $575,000. And that was like 19 years ago. So you think about it. What do we say at Lifestyles Unlimited? We say that real estate has a tendency to double in value every 20 years, right? So let's do the math. It's been 19 years. We're paying $1.67 million for this property. Technically, it's almost like tripled, right? In 19 years. The value, right? So, that's what we're chasing after, right? That appreciation. Okay. So you've owned that property for a year. In that year, you have paid out over $39,000 out of your pocket to pay the mortgage and the associated expenses on the property. And we're just going to assume that nothing broke. You had no repair costs at all. None at all. Now, here's the thing. You're losing money every year. You're losing almost $40,000 every year. I want you to keep that in the back of your mind, because not only did you write a check for $434,200 to get into this deal, every year you're writing another $39,000 plus to stay in the deal, to keep operating the property. So let's talk about what happens at the end of the first year. Well, real estate, like I said, it goes up in value. We're not really going to talk about that right now because my numbers are very, very conservative for the increase in value. But I want you to understand that you're going to get some of the benefits that we get when we invest in property. You're just not going to get all of the benefits. And the one you're violating right off the bat is the cash flow. There's really no reason to buy real estate to lose money every month. You can't have such a significant income and tax problem that you need massive losses in real estate to offset that stuff. As a matter of fact, it's kind of stinking thinking, because you're robbing Peter to pay Paul. Yeah, I know. Weird, huh? So why would you spend $40,000 a year so that somebody else can live in a property? Well, that's right, because it's going to go up in value, right? Well, let's talk about some of the things that did occur. You will get principal paydown. You did put a note on this property, and you're going to get in year one about $76,000 in principal paydown. And then just calculating a very conservative increase in pricing, and I'm going to use 3.5%. I know I already told you that historically real estate in San Francisco, it kind of tends to triple, and I like to use the double number. I'm going to stick with the double number because I think it works. Maybe I'll change my mind at the break. Maybe I'll come back and I'll go, I did something crazy. I went with 5.5%. You know what? I'm going to do that. I'm going to go with 5.5% because I want to make this deal as good as possible for you, because I really want to convince you that either this is a smart way to invest or this is a really dumb idea. I'm a little torn right now. I'm a little torn because San Francisco is such a beautiful place. And man, if you just own some property there, that would solve all your problems, right? When we come back from the break, I'll give you the lowdown. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. All right, so let's talk about these returns on this particular property. $5,800 monthly rent, $9,065 a month obligation. So you've got negative cash flow running at $3,265 per month. You're digging into your pocket to make up the shortfall because you bought a property that costs a lot more than the rent can support. But you bought a property in San Francisco and, based on your research, you determined that in the last 19 years, this property price has tripled. So that must make it worth it, right? That must make it worth it. Well, let's get into those numbers. So at the end of the first year, as I mentioned in the last segment, you've written checks that equate to a negative cash flow of over $39,000 in that first year. And you're going to do that for each subsequent year that you own that property. See, what you're doing right now is you're trading cash flow for appreciation. And we don't believe that's a smart idea. We believe you should have both. You should select assets that provide both. Not only the cash flow, but the equity growth. So let's talk about these 5 ways we make money in real estate. And this is single family property, so we're not going to talk about forced appreciation, which only occurs in multifamily properties. We're going to stay in that single family space. So cash flow, you're losing. You're paying out of pocket every month. We don't think that's a good idea, but maybe you do. So cash flow is a no-go. Equity capture. Oh, wow. Because you paid retail for this thing, you didn't even find something that was junky and fix it up. You just went out and found something that was all fixed up and ready to go so that you didn't have to go through the hassle and the time of fixing the property up. So because you paid full retail price, actually you paid above retail price because everybody, it's just the way the market is right now. Your net equity captured is ugly. It's ugly. Yeah, I mean, your numbers are in the negatives. I don't even want to talk about it because when you take a look at the fees that you paid to get into the deal that essentially become over and above the purchase price, yeah, you're running negative equity capture. So that's a no-go. So right now you're 0 for 2. Well, let's talk about principal paydown. Okay. This particular loan will pay down over time. Yeah, it will, because you've got a $1.336 million note, and it's going to pay down approximately $132,500 over a 5-year holding period. Okay? So that's a benefit. You're getting some equity increase on the principal paydown. Now, let's talk about appreciation. And I did what I said I was going to do. I went in and I adjusted my numbers. I took them from a 3.5% growth rate, which is what I use for properties that I analyze, and I jumped to a California growth rate of 5.5%. Yeah, I did. I'm on your team, man. I'm trying to help you here. Okay, so what that means is that in year one, the property should go up about $87,000. All right, now we're starting to see the magic, right? Year two, $92,000. Year three, it should go up about $97,000. Year four, about $102,000. And year five, about $108,000. So all of that appreciation, just based on a 5.5% growth rate year over year, should get us to a 5-year appreciation of $485,000. It's actually a little bit more than that. And you're getting excited now, okay? Because now the numbers are coming together. Because now we're getting appreciation. Now, when it comes to the tax benefits are really going to, I'm not going to factor those in. But because you're losing money on this property and you're still writing off $46,000 worth of depreciation, you actually have probably about $85,000 in losses that you could show. But you need to talk to your CPA and not take my advice on this, because I am not a CPA and I am not advising you on accounting matters, just so that we're clear. All right, so what does this deal do at the end of 5 years? Okay, let's think about that. Over a 5-year period, you have contributed a lot of money to this particular property. Yeah, you're probably getting close to about $650,000 that you've actually injected into this property in order to allow that property to go up in value. So I'm actually computing your future value at around, let's go with a better number here. Now, let's just say it's about $2.2 million. That's a big number, right? Because you bought it at 1.67, but now it's worth $2.2 million. But then when you take into account that you've got negative cash flow, as a matter of fact, you have paid $195,900 out of your own pocket every month for 5 years, and you were running an accumulated loss. Okay, it's 9% loss on cash flow every month, or every year, which translates into about a 45% overall loss on the cash flow. Yeah, it doesn't get better as you keep paying into it. It doesn't. You're going the wrong way. And on the appreciation, we're looking at about a $2.2 million future value. And then when you calculate in the fact that we're going to pay down the principal a little bit more, maybe we're at about a $2.3 million return. But here's the problem. Here's the long pole in the tent. This particular property, over time, if you own it and operate it, and even though it's going to go up in value, and we're projecting about a 2.2, maybe a $2.3 million price in the future that you're going to sell at, when you take into account the appreciation, which was a positive for you, and you look at the cash flow, which was a full-blown negative for you, you have to mesh those together, because it's actually a blended return that you're getting. So what are you getting? Well, it's not great. I'm not laughing at you. I'm really not laughing at you. But my numbers are telling me that long term, you're going to make about 80% on the adjusted capital gain over 5 years. But when you take into account all of that negative cash flow, that actually reduces your annualized return. I'm sorry, annualized is the wrong word. The entire period is what I'm talking about. The entire 5-year period. Your return on investment drops to 34.45%. 34.45%. So now you're saying, okay, well, what do we need to do to make that negative cash flow go away? What do we need to do? All right. I like the way you're thinking here. So you understand the importance of cash flow. You also understand that you don't want to pay out of your pocket every month. So the one thing that's out of whack here on this deal is that principal and interest payment, because the insurance, that's going to stay the same regardless of what your debt is. Your taxes, that's going to stay the same regardless of what your debt is. That homeowners association fee, same. You can only mitigate the principal and interest. In order to get this deal to an approximately break-even cash flow, in other words, to a point where you're not bleeding and hemorrhaging money every month, month in and month out, you're going to need to put about 60% down on this property to make the numbers work, to get to a break-even cash flow. And I'll tell you this, if you're putting 60% into a property to not make any cash flow, I mean, we're talking $1 million here, man. Come on, think about it. You'll drop $1 million into one property to have break-even cash flow so that in the future, you can drive that property from $1.67 million to $2.3 million, and you can realize that gain. I will tell you this. If you've got $1 million to do this, you need to be in multifamily investing. Because I will tell you this, $1 million correctly applied to multifamily investing will create cash flow income streams for you when you do it correctly. When you do it correctly and you buy the assets in the right place, that $1 million is going to set you up for financial freedom in a way that you don't even realize yet. And I'll tell you this, a multifamily apartment community that you invest $1 million into is going to give you much better returns than a single house on a hill in San Francisco, California with $1 million views. Yeah. Here's the moral of the story, folks. Invest correctly. And if you want to find out how to do this correctly, go to freeworkshoplivestream.com. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.